Welcome to the presentation of marginal costing. Hello, Srikar Reddy of B3 roll number. Agenda. Meaning of a marginal cost and a marginal costing. Marginal cost was absorption cost. Such income under both marginal costing. Rahul phone ఏం గెలుతున్నావు అది పాత్ర లేదు పీక అది లైట్ ఓకే రాహుల్ ఫోన్ marginal meaning of a marginal cost and a marginal costing. अरे टाइप टॉप वॉच यूट्यूब cost meaning of a marginal costing, cost and marginal costing. Marginal cost was absorption cost as a certain income under the marginal cost and absorption cost. Introduction. The costs that vary with the decision we should only be included in decision analysis for many decisions that involve relatively small variations from existing practice and or are relatively limited periods of time. Fixed costs are not relevant to the decision. This is because either fixed costs tend to be impossible to alter in a short term or managers are reluctant to alter them in a short term. Definition. What is marginal cost? The cost of producing one or more unit or the cost of which can be avoided by not producing a unit. The cost of producing one more unit or the cost which could be avoided by the not producing a unit. What is marginal costing? Approach in which only variable costs are included in a cost in cost of sales. Fixed costs are treated as a period cost and are written as the marginal cost of the product. Variable cost, direct labor plus direct material plus direct expenses plus overhead. Theory of marginal costing. టైం పెట్టిడా నువ్వు నేను డబల్ టైం చదవడానికి వస్తుంది పెట్టు యాజ్ సెట్ ఆఫ్ అ సీమా లండన్ in a relation to a given volume of output. Additional output can normally be obtained at less than appropriate cost because within limits the aggregate of certain items of cost will tend to remain fixed and only the aggregate of a remainder will tend to rise proportionally with an increase in output. Conversely, a decrease in the volume of the output will normally be accompanied by less than appropriate fall in aggregate cost. Simple step to understand about here. If the volume of the output increases, the cost per unit in number of circumstances reduces. Conversely, if the input reduces, the cost per unit increases. Example: factory produces 10,000 units at a total cost of 3,000. By increasing the output by 1 unit, the cost goes up to rupees 3,002. The marginal cost of the additional output will be rupees 3,002 to 3,000. Continue. If an increase in output is more than one of the total increase of the cost, dividing the total increase in output will give an average marginal cost per unit. Example: the output is increased to 10-20 units to 1,000 units and the total cost to produce these units is rupees 1045. The average marginal cost per unit is 2.25. This చూపిరా బే నువ్వు అది చూపియో అది ఈ ఫోన్ అది ఈరా ఏమా అది ఈరా బే నువ్వు ఫోన్ ఒకసారి ఒకసారి ఇయ్యనా ఒకసారి ఇయ్యు ఒకసారి ఇయ్యని అరే నువ్వు మస్సా కాడ జోలకు ఫోన్ ఒకసారి అది ఇవ్వు ఫోన్ అరే నువ్వు ఇయ్యో ఫోన్ ఏం లేదా నువ్వు అది వస్తుందామన్నా ఏం వెళ్ళదు అన్నీ రాకులే ఉన్నాయి మా అంటే వాట్సాప్ చాట్ చూసినాము ఏ పొరుగులు దొరికిలేము వల్ల చూస్తున్నాం అంతే టైం అడిషనల్ కాస్ట్ నన్ను గెలుకకు 4 ఏయ్ అరే నువ్వు దమ్ చేస్తుంది explanatory definition. Marginal costing may be defined as a technique of presenting cost data wherein variable cost or fixed cost are shown separately for managing the decision making. It should be clearly understood that marginal costing is not a method of costing like cost costing or job costing. Rather, it is simply a method or a technique of analysis of costing information for a guidance for a guidance of management, which tries to find out an effect on profit due to changes in volume of output. Alternative name for marginal costing: direct costing and variable costing. Concept of contribution: contribution is equal to sales revenue minus variable cost, marginal cost. Contribution may be defined as a profit distribution before the recovery of the fixed cost. Thus, contribution goes towards the recovery fixed profit. Contribution may be very defined as a profit before the recovery of fixed cost. Thus, the contribution goes towards the recovery of the fixed cost, and profit is equal to the fixed cost plus profit. Contribution: fixed cost plus profit. Break-even point: in case of a firm neither makes profit nor suffers loss, contribution will be just equal to the fixed. C is equal to F. This is known as a break-even point. Relation with marginal costing: the concept of contribution is very useful in the marginal costing. It is as a fixed relation with sales. So the proportion of contribution to sales is known as PV ratio, which remains the same under given conditions of production and sales. The principles of marginal costing: for in a given period of time, fixed cost will be the same for any volume sales in the production. Provided that the level of activity is within the relevant range. Therefore, by selling an extra item or product or service of the following will happen: revenue will increase by sales value of the item sold, cost will increase by the variable cost per unit, profit will increase by the amount of contribution earned by the extra items. Continue. Similarly, if the volume of sales falls by one item, the profit will fall by the amount of the contribution earned for the items. Profit measurement should therefore be based on the analysis of the total contribution since the fixed cost related to the period of time, and do not change with increase or decrease in sales by misleading to the charge of units of the sales with the share of the fixed cost. Continue. When a unit product is made, extra cost included in its manufacturing are the variable products cost, fixed as costs are unaffected, and no extra fixed costs are incurred when output is increased. Features of marginal costing: cost classification, stock inventory valuation, marginal cost contribution. Cost classification: the marginal costing techniques makes a sharp distinction between variable cost, fixed cost. It is a variable cost on the basis on which the production and the sales policies are designed by the firm following the marginal cost techniques. Stocks inventory valuation: under the marginal costing, the inventory stocks of the profit measurement is valued at a marginal cost. It is in a shape contrast to the total unit cost under absorption costing methods. Marginal costing contribution: marginal costing techniques makes us the marginal contribution for making various decisions. Marginal contribution is the difference between the sales and the marginal cost. It forms the basis for the judging profitability of the different products of department. Advantages of marginal costing: marginal costing is simple to understand by not changing fixed overhead to the cost product. The effect of varying charges per unit is avoided. Marginal costing versus costing. After knowing the two techniques, marginal costing and absorption costing, we have seen the net profit not same because of the given reasons. Reason between the net profit in the both cases: over and under absorbed overhead, difference in stock valuation. Marginal costing of absorption known as థ్యాంక్ యూ.